On this week's episode of the Silicon Valley Podcast, we sit down with Andrew Butt, who is the founder and CEO at Enable, created the rebate management software category used by manufacturers, distributors, and retailers globally to increase sales. They have just been labeled a unicorn company. On today's episode, Andrew talks about the startup ecosystem, UK versus Silicon Valley, expansion routes and advice for Silicon Valley companies, evaluating ideas for building a company, evolution of SaaS over time, key metrics for company tracking, organic growth versus acquisition, and much more. This is a jam-packed episode that people are gonna love. All right, let's start this week's episode of the Silicon Valley Podcast. Enjoy. Andrew, I'm super excited for this week's episode of the Silicon Valley Podcast, and I want to say congratulations. I just heard you passed 500 employees. So, I did a lot of research on your company, on your history before the interview, but for our audience out there, can you give a brief history of your career up until this point?
Sure, absolutely. Yeah, so I really started building software applications at a very young age. It was just me and one other guy in my school, really, who were into computers in those days. I'm kind of starting to age myself a bit now, but we were kind of always building computer software. And from there, we actually launched our first company together. So this was a friend of mine in school and me. And we kind of started building applications. And then from there, really kind of grew the business and launched new businesses. So I guess in one way, I've never had a proper job. I've just always been sort of building and creating companies and working for myself. One thing I would say, though, is a huge experience was working with my co-founder, who actually runs a very large and very successful distribution company. And so I got pretty involved in that business and in distribution. And that certainly kind of helped to form what Enable has now become.
What was that first business partner you were working with? What's the history there? Is he still involved in your companies, or is he doing some? Sure. Was the entrepreneur route not for him?
Yeah. Well, you see, my other interest in life alongside computing has always been flying, and so I always wanted to be an airline pilot. And
really?
Yeah, and that didn't happen. But I did kind of stumble into a flying school in the UK as a kid, really, and met the owners of the flying school, started helping out with their IT and so on. And I met my co-founder there, and he was already a very successful business person running this and owning and growing this distribution company. So that was how we met. We were both learning to fly, and it was actually helicopters we were learning to fly.
So the distribution partner now is the same person that you met way back then?
Yes, correct, absolutely. So he was a founder with me in this company, Enable, and remains a major shareholder.
What a story! So, and how many years ago was that when you met?
Well, when we first met was literally like 23 years ago. So year 2000, when we very first met, and then we built different businesses together. And this kind of Enable as it is today, I think really kind of kicked off in about 2016, 2017. But prior to that, we had various different businesses.
Okay, so all the businesses you created up until this point, were they all in the UK, or were they international, or were they in the US?
No, they were all in the UK, and we always, or not always, but we had customers in the US and elsewhere from quite an early stage, but we never had a presence in the US. It was just kind of like serviced remotely from the UK.
And then this company, though, would you say the majority of it is in the UK or the US, or?
So we've just tipped the scale now where we have more people in North America than we do in the UK. Only just though. So of those 500 people, about 260, I would say, are North America, and then probably about 230 or maybe a bit less is UK, and then we have Australia as well. But we've actually got a big focus now in Canada. So for us, Toronto is a very big base, and that's where a lot of our people are.
So tell me how the difference in the entrepreneur ecosystem is between the UK, US, and actually, if you want to throw in Toronto, I'm very curious about how those are just the dynamics there.
Yeah, sure. No, very different, I would say. So in the UK, the approach to building a business, certainly when I was there, was really starting very small and growing organically. So you would kind of try to get to profit quickly, and then you would invest some of that profit in growth. But it was really very, very steady growth, and you could say quite cautious growth. And by doing that, it was hard to get big quickly, because, if you're only investing your own cash flow, then that's a very limited kind of source of investment. Whereas I think what I saw is in the US, and particularly on the West Coast, then the view was, if you've got kind of product market fit and something where you can really kind of take the market fast, then there's a lot of investors who are willing to fund that growth. And it's absolutely fine to kind of burn capital as long as you are kind of capturing market share, you've got product market fit, and that your kind of fundamentals are strong, and that you can get to profit, later. Obviously, if you can never get to profit, that is a problem. But as long as you can prove that you can get to profit, but you want to really capture the market and get to scale, then you can raise capital and you can invest that in growth. So that was a huge difference in mindset, I'd say, between certainly the West Coast and the UK. And then I'd say between it's in the middle. So East Coast was kind of not as aggressive as the West Coast. And over the years, that has changed. So I do think I'm generalizing, and there are certain investors, in the UK and on the East Coast who are now a bit more like a West Coast investor. But I sort of voted with my feet and moved from the UK to the West Coast, and that's because I believed, and I still believe, that for kind of ambitious entrepreneurs, if you want to really kind of build something big and impactful, then raising capital on the West Coast is, I think, what I did and what I would recommend.
How has your mind have to shift from being a founder of a company that's grown organically, where your money's coming in and you're reinvesting it, to that VC-backed company where it's growth? How have you, as an entrepreneur, as a founder, had to change over that time to accommodate each of those two?
Yeah. So it certainly was quite a big change, and I think in kind of hypergrowth, unfortunately, there is a certain amount of waste, because it's like launching a rocket. If you kind of were launching a rocket and you said, what's the fuel economy? It's kind of just not that relevant. You're trying to get this rocket off the ground. So it's about, effectiveness versus efficiency. And initially, you're just trying to get effectiveness. So you're not bothered about efficiency. And then later, once things are really starting to be effective, then you worry about efficiency. So I think, your question, that was quite a big mindset change, and it did take me a while. And I think some of the investors that I pitched were worried that I wouldn't be able to make that shift, because they said, you're going to be so careful right now, because it's kind of like your own money basically, and we'll need you to be a lot more kind of aggressive at deploying this capital that we're going to inject into your company. We're not sure you can do that, so it certainly was a shift. But it's a long distant memory now, to be honest. We've been in this new mode for several years. So they were nervous about you deploying capital fast enough. Well, certainly, I remember hearing that from at least a couple, and they didn't end up investing. So, and I'm not saying the current investors, but when I was kind of pitching investors, I know that was a concern that might come up. Okay, then how did you prove them all wrong? I mean, were you just spend it, or how did Well, no, as I say, I think I just remember that comment from one particular investor who we didn't end up raising with anyway. So, but I just remember thinking it's a good point that investors that are investing in an early stage company don't want to put money into that company and have it just sitting there. They want that to be deployed, and hopefully for it to be proven to be a big success. But actually, if it's not going to be a success, they'd rather it kind of you prove that it's going nowhere quickly, rather than just hanging around and having it kind of sitting in the bank account. So that was on my mind in terms of how can I make sure I do that. But I think we made the transition, and now, as I say, that's a distant memory, because we're growing so fast, and we're definitely not concerned about. We are. Let's just say we are deploying capital.
How did you decide that this was going to be the company that you were going to add rocket fuel to the fire? Why not take this company, the idea, when it was very early on, and try to do the organic, the self-funding?
Sure. Yeah. Well, I think we'd done the other route before for many years. So before this, then really we were in the business of building software for other people, and we were a services company. So we would take on a software development project and then charge for that. And it was all, selling time and selling services. And that, again, grew kind of steadily, slowly, kind of profitably, but was never going to be huge. And I kind of dreamed of building a product rather than just building software for other people, actually building my own product and doing that. And the particular space we landed on, which we'll talk about, rebate management, this was something where we were being approached by quite a lot of companies to say, this is something we need. Can you build software for this? So we kind of built several bespoke systems to manage rebates. And it didn't take us too long to realize this was a real kind of gap in the market. So we said we can take our dream of building a product, and this is the thing which clearly is needed. So, it took us a while to get there because I was doing the previous model for many, many years, but I thought I better, do this before it gets too late.
How long were you doing the previous model for? And you'd also mentioned starting many companies. Can you kind of dive in a little bit deeper? What were some of those companies you had started before leading into the software development,
Sure.
Which that's actually genius how it's, the market's telling you what to build.
Yeah.
And then pick it. So
yeah,
I want to dive in that more, but tell me about the journey up to that a little bit more.
Yeah. So I would say the initial kind of company was just me as a kind of, one-man band, kind of just building software applications for people. And it was just very, very small. And then I met Dennis Short, who's the guy that was building a very successful distribution company at the helicopter school. And we got together and he said to me, look, let's start a company together and really build software. So his company is called DCS and we called our first company DCS e-commerce. And this is going back to like early 2000s. And then it would start to grow. So it was still building software for other people, but we were hiring a team. And, we got to quite a reasonable sized team of maybe 50 people, for example,
wow.
by let's say 2010 or something. And then another business was that one of our customers actually approached us. So this is a company we were building software for. And they said, we've got a lot of ideas here, but we'd like some help. Would you consider investing in our business? So the two of us invested and actually became a 50% owner in this customer business. And that was selling software for health and safety management and construction management and that type of area. So we built that to a good sort of 7 figures of revenue. So not huge, but a good reasonable size. And that was eventually acquired by private equity in the UK. So that was acquired by a firm called Sovereign Capital in the early like 2010 or 2012 or something. So that was also a good kind of experience.
When they acquired it,
yeah.
Did you walk away or did you have to stay there for a year or two?
Yeah. So I walked away, but the fun part of it was we continued to be a supplier. So if you imagine we were supplying this company and then we became kind of directors and shareholders in the company, and then the company was sold or acquired, but then we continued to supply that company with software development services.
So
that worked quite well. And then really it was from that we then said, okay, we want to launch our own dedicated product business, which led to Enable, what we have today.
So what was the switch from, actually, let's even go back further. I'm curious, what triggered you to say, hey, I want to sell this company to the private equity group? Why not hold on to it, build it even longer?
So I think the fact of the story was, so Dennis and I were not really the lead kind of people in that business. So we'd come in later and invested and got, joined the company and became a major kind of, major shareholders in the company. But there was the two founders, the two original founders of that business, and they were driving it. They were the driving force behind it. And so I think they, we wanted to go in slightly different directions, and it just made sense. It was very positive and amicable, so it was all good. But they continued to run it as part of a larger group, and then Dennis and I kind of moved away. But like I said, we continued to supply that company for many years after, so it's all good.
Okay, and then so companies sold, still got those relationships. Now you're getting more requests to build out all these different types of software, but one you're getting more requests than anyone else or any other type, and that's the one you went, wait, there's something here. Do we jump on this opportunity, or do we possibly miss the next big thing?
Yes. Yeah. And I think for at least a couple of years, we were kind of incubating that product business, if you like, within the services business. And we were kind of using the profit we were making from the services to try and build and launch this product business. And that's what we did for probably a good couple of years, up until about 2018.
Well, why not in that time? Because it did sound like you're growing it all organic. Money's coming in, you're investing into this company. Why not right when you saw that as a great idea, go, this is the one we're going to go raise funding for?
I think just really, to be honest, lack of experience was one. And then we'd never raised money before. And I think we also wanted to kind of prove it out. And again, ideally get that initial product market fit, so we could go to investors and say, this isn't just an idea. This is now actually live with quite a few customers and lots of good case studies. But I think we did take some time, and that had lots of benefits in terms of the lessons we learned and setting it up for success. But the danger was, almost to your point, that we would just carry on for a long time trying to do both. And it did become clear to me that wouldn't get the best result. It was too diluted. We had to be focused. So that eventually led us to basically shut down the services company, or not even the company, we kind of pivoted the team. So the same team who were doing services moved across to the product. And then we tried to kind of carefully wind down the services so we wouldn't disappoint those customers. And anyway, so that was a transition. And you could say, we could have spent too long doing that.
Talk a little bit more there, because one thing that comes up quite a bit on the show is companies pivoting.
Yes.
So what, like that decision to pivot right there, how did you go about planning it?
Yeah. Well, I think, again, we had to run them both in parallel. So if you imagine, it was one engineering team, and they were kind of half the time building our own product, and then the other half the time building products for other people, and then we're being paid to do that. Okay, so that was quite manageable. And then we realized, the product business was the way forward. That was the much bigger opportunity, but it would mean we would have to go from being profitable and cash generative to a burn situation. So we would have to raise capital. And so really that's when I came out here to the Bay Area and was knocking on doors. And once we got the Series A kind of secured, then we immediately started winding down, because we then had the capital to keep everyone kind of funded for a while.
Did you first try to go to UK VCs, or first stop Silicon Valley?
So I definitely had conversations in the UK and Silicon Valley and elsewhere. And at that point, I wasn't even asking or saying I wanted to raise. I was just exploring. But it did become clear to me, and I just really I just knew that I wanted to do it here. So as soon as we got into actual fundraising mode, we did just show up here and do it here. We didn't try to raise in the UK.
Was it more challenging, I would say, or ask for a UK company to raise capital here in Silicon Valley versus a company that has a headquarters here? Were people asking you, hey, if we're going to invest, you need to set up an office here?
Yes.
What were those conversations like?
I mean, I think the short answer is yes. I think it is more difficult. I think Silicon Valley is fantastic, and I'm a huge fan, so it's definitely possible, and they really were accommodating. So I've got nothing negative to say. But it was harder, because when I first came here, I was on a tourist visa. I didn't have a visa at that point very early on. And you're right, we didn't have an office here. We didn't have any people here apart from me. We didn't have a company, an entity in the US. Didn't have a US dollar bank account. So it was definitely a more challenging process compared to being a US company.
For another European company or a company overseas that's looking to set up operations in Silicon Valley, how would you recommend the first steps? I mean, what did you do? What were some of the lessons you learned?
Yeah. So I was very committed to being here. So I moved across, and I kind of had met some investors and said to them, look, I'm going to move here. I'm going to be here. I'm not going anywhere. And I'm looking to raise when I get here. And that, I think, is a good commitment, because if you just kind of say, oh, I'm actually living in, Europe or the UK, and just give me some money and then I'll leave, I don't think that works so well. So my wife and I literally had committed. We were coming out here. We were moving our life here. And I think that was quite important.
How did you convince your wife?
it wasn't difficult. I literally went home one evening in middle of 2018 and said, how do you feel about moving to California? And she said, yeah, let's do it. Let's move tomorrow. So she was easy to convince.
Sounds like a lot of back and forth there.
I was the one that took my time, actually. So she was sort of saying, let's get going. And I was saying, well, hang on a minute. I need to, she'd already so she was born in Hong Kong. So she'd already moved from Hong Kong to the UK. And so for her, moving from the UK to the US, she kind of done it. Whereas for me, I was thinking, do I really want to live in the US? I don't know. So it took me a lot longer than her to decide to do it.
Oh, that's interesting.
Yeah.
And then when you and your wife came here to the US, I mean, some people say raising later stages is a lot easier than raising that first round. How have you experienced it?
Yeah, I think that's how I found it as well. So I think the first one, we were totally anonymous. No one knew who we were. It's just, you're what, UK company? Doing what space are you in? And it was a new category as well. So that was definitely the most challenging. And then I think we've been fortunate and the company has performed well. So that has really meant that investors then came to us. So that was our Series A originally, and then we've done a B and a C. And in both cases, we had really good investors knocking on our door. And it was definitely more straightforward than the Series A.
What's it like working with tier one VCs?
Yeah, pretty good. I mean, to be working with people who are on the boards and associated with some of Silicon Valley's most successful companies of all time is brilliant. And that's exactly, again, why I moved here, because I wanted to be surrounded by those kinds of people who had that experience. So I think in terms of, benchmarking, SaaS is very well defined now, and it's very easy to compare companies. And so I've got access to all that data and knowledge, and also understanding what companies do in different situations. And of course, these investors have gone way beyond where we are now in terms of scale. So I think it's always important to have companies that are just way ahead of wherever you are, so that you can kind of scale. So
you had mentioned that the metrics are pretty well defined right now. What are the SaaS metrics that you're tracking that people should be tracking, and kind of what stage? Because I'm guessing the metrics you track pre-seed versus Series B probably aren't the same one. So any thoughts, suggestions on that?
Yeah, I mean, I think in a kind of B2B SaaS model, then the number one metric really, certainly in the early stages, is annual recurring revenue, ARR, and more importantly, ARR growth. So whatever the ARR is, it needs to be growing consistently quarter over quarter. So that's, I'd say, number one. And then the next one for me is burn, because the two are intrinsically linked. That ideally you want to be burning not very much and growing very fast, and that's hard to do. But the worst case is that you're burning a lot and not growing fast, or not growing at all, or whatever. So those two, it's almost like the top line and the bottom line, ARR growth, and then net burn per quarter. And so those two I follow very carefully.
Why did you say they're per quarter? Why not check it monthly, weekly? How often do you check?
No, that's a good point. I mean, I think in B2B SaaS and kind of enterprise segment where we are, then the overall cadence is quarterly. So it's like a quarterly sales cycle, and it's all quarterly, and the board meetings are quarterly, and we report quarterly, and public companies report quarterly. So, but yeah, you're right. Internally, you need to be looking at it more than that. So we look at lots of things weekly and lots of things monthly, but we kind of report quarterly. And I think also you can have a good week and a bad week, or a good month and a bad month, but you can't really have a bad quarter. It's got to have, every quarter's got to be good. Even you sort of have to. You might have, again, good and bad weeks, but overall the quarter has to be good.
What type of pressure is there, or kind of the documents that you're expected to prepare for these quarter meetings? Because it's not a public company, it's not the same regulations, and each VC kind of has their own little, this is how the format, this is how we want it presented.
Yeah.
For our audience out there, what's the package that you prepare every quarter?
Yeah. I mean, I think you mentioned pressure. I think the great thing that I found is that I do think we're very aligned with our board and very aligned with our investors. So what we want is what they want, and vice versa. And there is a lot of pressure for sure, but it's kind of our own pressure, because we want to grow and take market share. And it's a self-fulfilling prophecy, really, because if a company doesn't grow, then it can't be financially strong. And then it can't invest, and then the whole thing kind of goes the wrong way. Whereas if you want to grow and you've got that ambition you want to deliver on, you have to perform. And if you can perform, then you can be financially strong, and then you can invest more. And so we put ourselves under pressure, really. And you're right, there's not that many regulations as such, but we want to really be very prepared for the quarterly meetings, and the information has grown over the years. So in the Series A, it was not so much, and the investors were very helpful in giving us examples of what they wanted. And then as we've got bigger, it's become kind of more comprehensive. But it's really just we have an overall company report, I guess, which would say what the key SaaS metrics are per quarter versus plan. We'd have the financials in terms of P&L, balance sheet, cash flow versus plan. And then each function, whether it's customer success, engineering, revenue, product management, people, will have their own kind of metrics they report on as well.
And then those quarterly reports, how far in advance are you planning? Are you planning the next year, the next 24 months, until the next raise? Kind of what's the timeline look like?
Yeah, so we've kind of got a long-term vision, which at the moment is probably, we actually have 3 time horizons right now. So 3 to 5 years is the longest one we think about. And then the kind of 2 years before that is like the middle time horizon. And then probably the next 3 quarters is the immediate short term. And I think in terms of financial plan, we want to be looking at certainly 2 years at a time. So right now we're kind of looking at this year, which for us finishes on Jan 31, and then the following year. And we've got kind of financials by quarter mapped out until the end of next year, which is January 2025. And then we have actuals versus plan. And that's, I think it's always like this year or next year.
And we haven't even really dived into what is rebate management software. So could you give us some insight, an overview of that?
Yeah, absolutely. So I'd say that rebates in B2B, quite different to the B2C idea, are a bit like a sales commission in the supply chain. So you've got manufacturers making products, and then distributors selling those products and supporting them, maybe. And those companies need to work closely together to kind of support customers. And manufacturers very often want to pay for performance. So when the distributor has achieved certain volume goals, they've reached certain levels of purchases or certain levels of sales, then they will pay them a rebate, which is like a commission check. And it really is effective at driving behavior. Because if I said to a salesperson, I'll pay you $100,000 right now, and if you sell nothing, don't worry about it. Or if I said, I'll pay you $50,000, but then if you hit these sales numbers, I'll give you another $50,000, then they'll probably do something and work hard. So that's the same in the supply chain. And you can probably imagine that the people setting up these rebates are buyers and sellers. So buyers in the distributors and the retailers, and then the sellers in the manufacturers. And because they're buyers and sellers, they get very creative commercial terms. So it could be, again, different units of measure, and it could be that there's growth tiers, and that when you hit the next tier, you get a rebate right back to the first tier or not. It's really complex. And if you're a distributor, you will have maybe hundreds or even thousands of manufacturers you work with, all very, very different types of products. And the rebate agreements are, enormously variable. So it's really hard to track all of this and manage all of this. So that's where we started to say, most companies were kind of on Excel because their ERP systems couldn't handle that complexity.
I was wondering what was being used before.
Exactly. And that's where we started to just make it easier and have a system approach. But what's really happened across so many industries is the rebates have actually become all of the profit. So 20 years ago, a distributor might buy this for $1 and sell it for $1.50. Okay, and then that's
and for our audience, if you're not watching the video, we're holding up a water bottle right now. So
okay, this water bottle. And so if my math is correct, that's a 33% gross margin. They buy it for $1, sell it for $1.50, and that was fine. But now it's very different. And actually, a lot of companies are selling at their buy price, or very close to the buy price, or maybe even below the buy price. So often they're selling below the buy price. Okay. and then they're getting so many rebates if they can hit all the targets. The rebates are all of the profit, which is crazy, isn't it? So you look at a big company, and you would see a company they might have, say, $1 billion of revenue, a profit of 50 million, and then their rebate income is 100 million, for example. So without the rebates, they're actually losing 50 million. So that's how the industry has pivoted, because basically manufacturers want to pay for performance. They're not prepared to just give a margin for the benefit of having something in inventory. So rebates have become very, very important. We're talking about trillions of dollars globally. So it's a huge number. And it's something which most people have never even heard of until probably the last 2 years.
So companies were doing it on Excel.
Yes.
And they were coming to you saying, we have all these contracts. Could you write software independent for us? And then you said, wait, let's just do a white label one that could be used globally.
Yes, exactly. Yeah. And there's many different ways it can work. So we, for example, have lots of distributors who use our software, and they use it to manage all the rebates they receive from their manufacturers. And then we also have manufacturers who use it to manage all the rebates they pay to their distributors, but then also distributors might pay rebates to their customers as well. So, and they can be interrelated. So there can be, say, 3 parties that are trading, and the rebates depend on what I sell to you. But I buy products from one person, sell it to another person, and the rebate I get from the first person depends on the fact I'm selling it to you. There's a lot of complexity and kind of different models, and we've turned this into a collaborative platform. So it initially was just like a calculator. It was like a rebate calculator for the finance team, but now it's actually more like a kind of marketplace where buyers and sellers come together, negotiate these rebates, and we grow through the supply chain because each of our customers take us into their trading partners free of charge. Their trading partners can log in free of charge to Enable, and then some of those convert into full customers and start paying us money.
I'm just wondering 2 things. One, the sticky factor of this, because I'm guessing once the software is there, churn's probably almost nothing.
Yes.
And then the other is the data you're collecting must be crazy.
Yes. No, those things are both correct. So there is a real kind of exercise to embed the software and fully implement it, because to deliver the most value, we need to ingest the transaction data from our customer. So we really need to know all their sales and all their purchases, and that can take some time. So there is work involved to get this implemented, although the way we've built it means it's much faster than anything else that's on the market. But then you're right, once the customer is on board, they're very unlikely to go away unless we really do a bad job, because it's used every single day. And you're right that the churn is very, very low. And then you're also correct, the data. Yeah, so we've got, imagine all the purchases and all the sales of all the distributors and retailers and manufacturers that use the platform. And we've got all the agreements in terms of who gets paid what and when and why. So there's a lot of data there.
What would have more data on transactions and logistics? Yours or like an ERP system?
Well, we actually take all the transactions out of the ERP system. So let's say purchase invoices or goods receipt or whatever the transaction is in the ERP, that goes straight into Enable. And I think one thing we have is we have both sides. So we have the purchases and sales from each of the companies on the platform all in one place, essentially. Whereas an ERP system just really has the data for that one company.
And then in the past, you also acquired a company, Profectus Group RDM platform.
Yeah.
What was the decision with all the growth, with kind of access to a ton of capital, to go out and acquire a company versus build it internal? And then kind of what were the parameters or thoughts around that? Because you acquire, so outside the podcast, I'm an investment banker. When you acquire another company, you're acquiring that culture. There's a lot of disruption in that. What was the thoughts there of acquiring this company or internal, or kind of the thought process?
Yeah, so with that one, the software they had built was actually very similar to what we had built. So we weren't really buying it for the technology. It was more for the team. So there were some very, very talented people. And, I think all of them are actually still with us. So that's been good. It's coming up to a year now, and everyone has remained, and they're very good people with a lot of domain expertise. And that's an area we've struggled because we've hired a lot of people, and all of the people we've hired are very good, but a lot of them are not knowledgeable on the subject. And obviously we train them, but that takes time. Where we can find other companies where they've got those really knowledgeable people, that's a huge asset. Also, of course, they had great customers and they had great revenue. And the other key thing with Perfectus RDM is they were in Australia, and we already had quite a few customers there and a few people, but it was very small. So by kind of bringing them on board, it significantly increased our market presence in Australia.
And right now, companies are staying private so much longer. So I kind of have two parts to this question. The original, what I wanted to ask you was, with the growth of your company, how are the investors in that stay private longer? Or is that kind of mind shift switching now with the current environment? But I'm also curious, and I just thought of this right now, with companies staying private longer and your clients being private companies, your data must also increase in value as they stay private longer, wouldn't it?
I don't know if I follow the logic on that. So why would the value of data be related to whether a company is private or public?
Because if they're public, so much of that information gets out into the public. Sales, that. Yeah. But if they're not and it's private, and I don't know.
No, maybe. I mean, I hadn't even thought of that. I mean, I think what you're saying is just even the basics, like what a company's revenue is, for example, their total revenue. Yeah, you're right. We would know that because we're pulling all the data, and that in itself has a value. But we haven't even we're not even doing that. We're more in the detail of the data in terms of what someone is buying, what someone is selling. Are they buying well? Are they selling well? How could they do better at what they're buying and selling? But yeah, you're right. We've got a lot of companies in the platform with data like that. So,
going back to the original one though, right now are investors that stay private a lot longer, or is mind shift starting to switch a little?
Yeah, I mean, I think for a start, so we're a Series C company right now, and we're in triple-digit growth, and we have been since we started. So it's growing fast, but we're still we're not huge. And I'd say in the US, which is where we would go public, or we will go public eventually, then I think you want to be at least, let's say you want to be at, say, 300 million of revenue, I think, to go public. And, we're not there, and it's going to take us certainly a couple of years to get there. So, and we will get there. We will get there, but we're not there now. So I don't think we're really having those conversations about should we stay private, or because it's just, we definitely will be private until we hit that kind of threshold. But I think your point is right, that the capital that's available privately now is a lot greater than it ever used to be. And you see companies that are way, way bigger than some public companies that are still private. So I think the general sense is correct that companies are staying private for longer. I think the benefits of going public there's quite a few of them. Obviously, raising capital for the company, but again, I think private markets can give you the same now. There's liquidity for all the shareholders and the employees, which is great when you go public. And I think there are alternatives, but not as good as going public. I think also it can help you to have a better company, because in order to go public, you have to run things in a very systematic way. It has to be a very predictable business, beat and raise. So it can really help you to build a better company. And then finally, I think some customers only want to do business with public companies. Some of the really conservative, cautious companies, they won't even, that they want to use a kind of very established public company. So those would be the reasons to go public. But I think companies are staying private for longer.
It is interesting that companies only want to do work with public companies. I hadn't thought of that. But in this journey that you've taken, you haven't taken a vacation or really like a block of time off between companies.
Yeah.
I mean, many guests we've had in the show, they'll build a company, take a year off, travel Europe, then get ready for their next idea. How come it's just been go?
Yeah, I mean, I've always got something that I want to do. So in terms of, it's not like I'm trying to think of the next idea. It's been very almost organic in terms of how one thing has led to another. So there hasn't been any natural gaps. And, I really like what I do. I like working. And I feel I'm very privileged because I get to travel and, go and see customers, go and meet different people and teams within the company. And I can combine kind of work and pleasure. So I think I have like one overall existence really, where I'm doing some pleasures, some work, but it's all just blurs into one. So I just don't feel the need to have a long break.
On this journey, what's the most, or maybe one of the most valuable pieces of business advice you've received?
Yeah. I mean, I think would come down to hire people that are better than you. So hire very, very strong people, and also just surround yourself with very strong people everywhere. So certainly people you hire, but also, advisors, board members, if you can select really good board members and investors, and just the kind of subject matter experts really. So surround yourself with extremely strong people, and then also don't kind of put any one of them on like don't kind of listen to one of them and think that what they're saying is gospel. It's important to listen to lots of people and kind of take different things from different people, and then from there, I think you have to have your own mind as well. So you have to make the decision, decide what to do, and back your judgment. And it's better to make a high number of decisions and get some of them wrong than to kind of procrastinate. I think sometimes in the past I've sort of listened too much to say one person or been hesitant to commit to a particular path. And I've really learned, we have this thing now, disagree and commit, which I really like.
What is that?
Where I'll say to, let's say, my immediate team, this is the topic. What's your thoughts? And we'll get different views around the table. And some people think it's a great idea, terrible idea, and I listen to it all. But ultimately, I just made the decision. It's not a democracy where it's like votes, and it's not something where everyone has to agree. So I'll say, okay, I've heard what you said. Thank you very much. I really appreciate it. This is the direction we're going in. And then people disagree, but then once I say no, we're doing it, then they commit.
How long until you listen to everyone that you decide? Is it in that same meeting, or you go home and think about it?
It depends what it is. So I think sometimes it's way too long, that I'm thinking about it for way too long, and it could go on for a couple of weeks. And I think other times it's too quick, where I'm saying, no, we're doing this. And people are like, hang on a minute, and it's that they feel I'm not listening enough. So I think it varies a lot, but depends on what the decision is. So anything from in the meeting to within say 2 weeks.
You said to keep people around your inner circle, advisors, people that have done this. Do you have any mastermind groups that you're a part of, or any other CEOs that you discuss things with?
Yeah, so there's a really good group that I'm a member of, and it's called 10x CEO, and it's literally 10xceo.com.
Tell us about it.
So it's really a group of venture-backed CEOs in software companies, and they have 3 tiers. Tier 1 is kind of hundreds of millions of revenue, and many of them are public. And then tier 3, I think, is up to 30 million of revenue, and they're smaller. And then the middle guys. So they're all really, really good. But there's probably about 80 or 90 CEOs in that group, and we meet. Each group is about 8 or 10. So let's say 10 groups. Each group meets once a quarter for 2 half days, and there's a really good format to kind of make sure everyone is kind of working through some of their challenges and opportunities. And then there's monthly coaching just with a coach, and then also like an event where every single one of those people get together. I think it's every 18 months. So,
how long have you been part of this group?
I've been in the group since I moved to the US, which was 2020. So I reckon it's now just over 3 years.
So was it recommended by an investor, someone you met at an event, or how did you even hear about this group?
It was actually another CEO. It was another British CEO. So he came out here before me and was nicely ahead of me. And then when I was kind of learning about how to set up here, I got introduced to him via some, I think it was actually like Chamber of Commerce or some kind of government. It was really good. So him and I met, and he gave me lots of great advice. And one of those bits of advice was this group. So that's how I found out about it. He's actually since sold his company and is no longer in the group, but that's a more recent event.
Oh, they don't allow you just to kind of stay on it, even like an alumni group?
It says alumni, yeah. So I don't know if they do anything, but there is like an alumni section. So
that's fantastic. Yeah. Was there any question or topic that we didn't cover, or if there's anything else you'd like to talk about your company, now's the time to do it.
Yeah. No, I think I think in building a business, it's really important to have a clear intention of what you're trying to do. Because we talked about things like growing steadily and profitably, and that's great. And there's nothing wrong with that. And it's a certain type of business. And then raising capital is very different and has a lot of kind of advantages and disadvantages. So I think being really clear on what you're trying to do and having clear intent rather than almost accidentally going along is important. And then I think focus is important as well. So I think most of us, including me, try and do too much and really sort of narrowing down to something which is meaningful, where you can be could be the very, very best at that one thing. And that's something I've learned, and I've spread myself too thinly for too long in the past. So need to be focused. And I think the final bit is clarity. So we work very hard in our company to create a lot of clarity for our people on, for example, why we exist, what we do, how we will succeed, how we'll behave, and also what's most important right now. And those are actually questions from a book written by Patrick Lencioni called The Advantage. And it's creating very, very strong and simple kind of messaging, so there's that kind of clarity in the whole company, and constantly repeating that all the time. So, I think that's an important kind of mantra, I guess, that I followed.
Okay, we'll have that and everything else in the show notes. Andrew, if anyone wants to find out more about you, your company, what's the best way to go about doing it?
So our website is just enable.com. So it's really, really simple. And you can become an expert of rebate management and how rebates can work for your business and drive revenue and profit in your business. Just go to enable.com. And I'm on LinkedIn and use LinkedIn as my main kind of social media platform. So feel free to connect.
Fantastic. We're going to have that and everything in the show notes. For our audience out there, please visit thesiliconvalleypodcast.com to find out about this episode, our past episodes, and future episodes. And when I'm not the host of the Silicon Valley Podcast, I'm an investment banker focused on mergers, acquisition, growth capital, and secondaries. Connect with me on LinkedIn, Sean Flynn. Happy to have a conversation. And with that, Andrew, thank you for taking the time today to be on this week's episode of the Silicon Valley Podcast.
Good to be here, Sean. Thanks for having me.